just to make sure we're live. Good morning to you, Vernon, and good morning to all the people following us. How are you doing, my brother?
Never better, doing great, thank you. And how are you doing today?
I'm good. I'm good. And today is the 20th of June. 10 more days till the end of H1, people. The end of H1. Okay. Remember that it's just the first half of the game. There's a second half to go. So if you're still losing at the beginning of the first half, remember that you haven't lost the game. It's not over. It is the second half that will kick off. And remember that there have been many comebacks in the second half of the game. Many comebacks. So that is all we have to think about, Vernon. That is all we have to think about now. Let's get into today's market activity to get started. There is obviously news
Mhm.
flying around, but we're going to capture all that we dealt with today. We're actually looking at some market data roundup. Kwacha closed at 19.4631. So we're back up into these mid 19s. It's rebounded very quickly from the Kwacha gaining strength that we saw the previous time when there was an offloading of dollars onto the market. Now we are down to a situation where the Kwacha has actually lost again. So we're at $19.46, up 7.55% and up 1.78% on the week. So back in buying position. Our stock market was quiet yesterday, 8,235. It has remained exactly where it was, while the bond market is up 0.16% and down 0.56% in dollars. And the interest rates did move down below the 24.1 mark. So we are starting to see interest rates moving towards the buying side of things as well. But as you can see, there was a slight little dip in the dollar kwacha rate, and that has moved the rate back up to about 19.46. As you can see, 19.46 altogether. While simultaneously, Vernon, we are paying attention to the fact that we are seeing the rand also picking up. And I think my concern with the rand is the 1 month change. We've got a 10.75% change in the rand, meaning that South African products will be 10.75% more expensive, especially to do with cross-border traders. Just want to check quickly, Vernon might check. I hope I'm not getting any feedback. 10.75% that we actually are seeing so far in terms of the rand. So cross-border traded products are most likely to see some increase in costs coming through. So South Africa induced inflation is one of the things I am worried about, especially on consumer goods or finished goods that do come in from South Africa. But year to date, the rand is only up 0.46%, while the dollar is up 7.5. If you look at the bond market, one of the things we are seeing is that 0.16% up and 12.64% year to date is the GRZ bond index for the secondary market. This is a little bit below where we are currently sitting. On the primary market, we are expecting to see a little bit of a higher move, but there has been a slight jolt upwards in the secondary market year to date. The reason I say this, Vernon, is that the primary market is currently moving around 18.6% for hold to maturity old notes. But remember that the reason why we're seeing this 12.64% is because of the old bonds that are sitting in the system, the ones from 2 years ago when interest rates were sitting around 25, 32. In fact, not even 25, when interest rates were somewhere around the range of 32, 35. Those interest rates are the ones which are driving, or sorry, those bond yields are the ones which are currently driving a lot of the system. Remember, a lot of the bond issuance that's in the system happened. In fact, half of the bonds issued in our system happened in 2021. Okay, so just that year alone, and that was peak interest rates. So that's one of the reasons why the secondary market is yielding as much as it is compared to the primary market. So we do have a 12.64% increase here. Now, year to date, GRZ bond index also in US dollars is down. Unfortunately, you can see it actually is nosediving from that 300 point where it was. The reason, but it's still up 4.54% year to date. But remember, this is the strength of the dollar that's driving the weakness of the GRZ bond index in dollars. And as you can see, interest rates over the last 2 months have actually come down, though just in the last month, it's up 0.1%, year to date up 0.45%. But you can see rates are moving downwards in the GRZ bond yields. And remember that there is an auction, just to always remind people, there's an auction at the end of this week that actually has to occur. Expectations that interest rates will probably stay very much the same. We're not seeing any exchange rate movements that are justifying any movements, any participation of offshore investors yet. Until we get a deal on our debt, we're unlikely to see that moving around. And also there is a little bit of squeamishness about the global economic outlook so far. Taking a look at the commodities board, we did see that copper was down 0.3% yesterday, with oil also down 0.73% and gold down 0.34%. Copper is up 2.01% year to date, and oil is still down 11.48% year to date. This is basically on the index movements. Now, I mean, this is basically on the international market. Gold is up 7.48% year to date, and these are all related in dollars. We're looking at wealth insurance asset. Bitcoin was up 0.8% in Kwacha. There was just a very slight movement down of Bitcoin yesterday, but Bitcoin was up 0.8% in Kwacha, and it's back above the 500,000 for a full Bitcoin, while Ethereum is up 0.5%, up 33.441. It's at 33,441, up 0.5%. Bitcoin is still up 71.12%, while Ethereum is up 54.02%. Remember, these are very highly volatile assets. And in Kwacha, you've also seen gold is up 15.59%. So taking a look at where our broad markets are looking so far, 12.6% on bonds, 12.2% on the stock market, 7.5% in dollars, and 15.6%. So we're still in the defensive market. This has been a slow first half of the year. So that's one of the reasons we're still seeing a very defensive market playing around, with about 71% on Bitcoin, 54% on Ethereum. Now, the reason why those ones are high, remember, that's got to do with the first quarter. They had a very strong first quarter where they almost were up 100%. But if you measure from that first quarter, we've had a pretty bad run in Bitcoin and Ethereum. So you have to be very careful about the volatility of these assets and putting all your money in their stake. So that's something you really want to look at very carefully. Simultaneously, we're looking at oil. What are our expectations of oil price movements? We're expecting a 1.1 kwacha price movement upwards. 4.5%, mainly because of the weakness of the FX rate. Brent crude has actually been okay during this period. The problem has really been our FX rate getting weaker. So that's probably going to result in putting pressure on an upwards adjustment on the fuel price. Prep yourself. We are on the 20th day, so we're probably expecting in 2 days' time. That's when they'll probably do the actual calculation. That we've actually noticed somewhere between the 21st and the 25th is when they start doing the calculation, and it's already looking like we're heading towards a 1 kwacha price increment upwards on the petrol price back to 25.56, mainly due to the weakness of the currency. And as you can see, the importance of getting our currency sorted out and therefore getting our debt sorted out, because it's actually reflecting in the fuel prices. Now, in the good side of things, the good thing is the Brent crude price is not actually going up. So at least this is mostly in the hands of Zambia now. That this is something that can be resolved mostly in the hands of Zambia by actually trying to push through as much dollar inflow as possible, especially through our capital markets. Quickly, Vernon, let's start with our first deep dive before we open up the markets. We did get a piece of news that we'll be passing through, that FRA has frozen sales to millers. The agency has seen the supply of the commodity stabilize on the market and has served its purpose. Farmers, traders, and millers will resume regular market activity. But as of May 2023, we did see that year-over-year breakfast meal and grain inflation was still at 23.92% and 24.64%. And here are the charts just to show you what the inflation rates have been for breakfast meals since May 2022 going up. We're still sitting at very high levels of 23.92, but off the extreme highs that we were seeing in February of 25.72%. And also what we're seeing in terms of year-over-year inflation in grain prices altogether, off the 32% and down to 24.16. So this is where we're sitting in terms of our first deep dive. And our second one we'll be going to is a few stories analyzing China and the Chinese economies. Now, for those of you who are sticking around today, please stick around and check in on our main topic of discussion today, Vernon. We'll be talking about insurance. And I'll be talking about the probability of loss, the rationale. So I did an introduction to insurance about 2 weeks ago. We're going to be talking about the rationale of it. And for the next 6 weeks or so, we're going to be going into each type of insurance that a person should have in their portfolio, the general person who's trying to build wealth. What kind of insurance should they be looking at all together, Vernon? But first things first, we're going to be talking about the probability of an event happening and the impact of it. I want to be talking about risk and impact altogether. That is the rundown of our markets today. We'll be going into an analysis of China, news on the crypto markets, and then we will start talking about the insurance industry. That's the introduction to today's Behind the Markets.
Autumn of youth clubs in just a particular segment of it all together. Mutual, are you there?
I am back. I am back. Vernon, thank you very much for getting back to us today. Now, yes, as we were talking about, we're looking into some of our deep dive news before we get into our main topic of discussion, which is going to be insurance and what kind of insurance you should be having. Let's take a look at some of the news that we've seen from Goldman Sachs. This is important for the commodity sector and also for the global growth outlook. Goldman Sachs analysts have slashed China's growth outlooks from 6% to 5.4%. This is based on weak industrial data and retail data, which has left most investors concerned with the expected big China rebound of 2023. IMF still has the Chinese economic growth outlook for the year at 5.2%. Now, this news is actually playing out. You can actually see here that the industrial output compared to where it was pre-pandemic is still a bit weak. There has been a slight rebound in retail, but you can see that retail sales are starting to slow down. This was all the way up to April, but this is National Bureau of Statistics and also captured by Bloomberg as well. Now, if you look even deeper in commodity news, we've seen that both copper and oil both felt a fall yesterday, mainly because of uncertainties to do with China. And China's economy is navigating some powerful headwinds. In other words, things that are slowing down its economic progress, and the property and especially from the property sector, which has not healed from that Evergrande situation, and also a lot of the defaults that have been happening in the property sector and the retail and industrial sectors both came in below expectation. China is widely expected to cut its loan rate. It's widely expected to continue going on a rate cutting session, and we've actually seen in general that there were rate cuts in general There were rate cuts in general from China even yesterday. As of yesterday, we did see some rate cuts coming out of the Chinese economy. Now, obviously, the biggest concern that China is experiencing is capital flight. And we're actually going to show you a quick chart to show you this, that a lot of the millionaires are actually leaving China due to the wealth crackdown. Now, we did see the PBOC push interest rates yesterday down by 0.1% from 3.65% to 3.55%. And they were expected to continue doing this with a whole host of stimulus measures that are expected to come in and actually attempt to slow down the situation. So you can see one of the things that's actually affecting China the most, along with India here, is the loss of millionaires. China lost 10,800 millionaires. Now, remember, China has 5 million millionaires, so that's not exactly a percent yet. But 10,800 millionaires left China last year, with the expectation that another 13,500 are expected to leave China this year. Other countries who are experiencing a millionaire exodus was Russia last year with 8,500, and Russia is expected to only lose 3,000. So that already tells you how bad things are in China, that even Russia is losing less millionaires than China. Okay, Russia, who's under severe global economic attack, basically the world is trying to squeeze them because of the war in Ukraine. You can see that even they are losing less millionaires. Some of the countries that are, India is unfortunately suffering a loss of millionaires as well, 7,500. But China, you can see that's a lot of capital leaving. That's wealth leaving and going to other countries. So the millionaire exodus that's happening, according to the Henley private wealth migration, is actually showing that. But just to bear in mind, Vernon, Zambia still has about 800 to less than 1,000. So we don't have that many yet. I mean, they're more millionaires. In fact, let me put it to you this way, Vernon. They are over 12 times more millionaires that left China than they are in Zambia. That's how bad it is. Okay. That's how bad our millionaire wealth creation is. So just remember yesterday's conversation, people. Now, we are also looking at, as I said, this is one of the things that is concerning. Now, in terms of the crypto craze, people, we have found that Bitcoin liquidity is starting to dry up. Bitcoin's highly liquid supply indicator has seen a stark decline, currently residing in the near cycle low of 2.94 million BTC. So in other words, they're seeing there are not that many BTC on trades. This represents a 620,000 Bitcoin decrease from the January highs of 2022, thanks to a contraction in actively tradable supply and resulting in constrained supply. So in other words, a lot of people are actually keeping their crypto coins off the system. They're not trading them, actually holding them. HODL, as they like to call. And we have actually seen that Grayscale Bitcoin Trust nears all-time highs, nears 2023 highs, on the news that BlackRock is actually filing to put in its own ETF for spot buying of Bitcoin. BlackRock being the biggest wealth manager in the world, $9 to $10 trillion worth of wealth. They are now trying to enter into the space where they also want to put in a Bitcoin ETF, because a lot of people in the wealth sector do feel the need to at least put some money into Bitcoin, just to make sure, hey, if the world burns down, might as well not lose my millions. That's the main thing. Or the financial system burns down, might as well lose my millions. And now my problem I've often seen in the crypto space is that people with nothing want to go straight into crypto and become rich. When usually what I keep telling people is build wealth in the basic areas: bonds, it's businesses, bonds, buildings. Okay, and benefits. These are the areas where there's a lot of wealth that's being held, and we're going to talk about that tomorrow. But unfortunately, a lot of people want to go straight into Bitcoin. That is not the place to start getting wealthy. That's the place maybe where you start diversifying some of your wealth, and that's why we call it wealth insurance. But we are seeing that it's on the way up. And another piece of big news that's happening is the International Monetary Fund is actually working on a global central bank digital currency platform, said the IMF MD yesterday. And she did say that CBDC, this was last week, sorry, she did say that CBDCs should not be fragmented national propositions. To have a more efficient and fair transactions, we need a system that connects countries. And we need interoperability. So that's what she's actually pointing out. The IMF wants central banks to agree on a common regulatory framework for digital currencies that allow global interoperability. So in other words, what we're trying to see is a lot of countries are trying to now work on central bank digital currencies. We'll probably sign Zambia somewhere down the line, late to the party as usual. But This is something that you can see the IMF does have a plan for it somewhere around 2025 to 2027, 2027, let's say 2030 latest, but somewhere around 2025, they are trying to get a central bank digital currency platform moving so that as many central banks can start to onboard currencies and make it more efficient. Why are they concerned? They're concerned that if there's no harmony for a digital currency system, the digitization of the financial system and the decentralization of the financial system is giving rise to stable coins and giving rise to cryptocurrency. And that's one of the reasons people are engaging in that at a higher and higher level. So they're saying that the failures of the banking system to actually get up to date with that is actually what's causing a lot of this. So now the IMF is going to basically lead the charge by creating the interoperability platform for as many of the central banks to then create digital currencies. Why are digital currencies very important? Well, they'll actually bring down a lot of the costs of banking. They'll allow a lot more direct action. People fear them because they believe that one, mark of the beast, two, those are centralized controls. Not many people trust their governments now to have them controlling a digital wallet. But yeah, most of us really don't even mind. We know that they're already looking at what we're doing anyway. We know they're already peeping in, so why not? Yes, the balance is going to be whether the convenience or not. But that's the big question. But that is the news coming out of the IMF. This was news that did come out earlier that they were looking into it. Now this is announced by the IMF MD that they are working on a platform to actually bring this to life, and that is also adding to the crypto story. Now, Vernon, let's get into our conversation today and our topic of discussion. For all of you who are looking, remember that it is Finance Tuesday, where we try to work out things to do with your wealth planning, your finance. And we are back. Sorry, we just had a little bit of an interruption. But yes, we're in the season where we are talking about insurance. So just to give you a I'll figure it out moment, this is the size of the insurance industry. 5.34 billion kwacha in total gross insurance premiums as of 2021. This is 340% higher than we saw in 2011, where it was only 1.25 billion, and this has been growing at a rate of 16% per year. So that shows you that the insurance industry is actually a fast growing industry of 5.34 billion. That is just under 1% of our GDP altogether. Now, if you're taking a look at our charts here, it even shows you this is how insurance premiums have actually been looking in general. So you can see life insurance and general. So life is more the long-term issues to do with health. Like I said, health, credit life, those kind of things. You'll see them when we play them out. And it goes all the way, as you can see, the growth has been in both sectors, both life insurance and general insurance, short-term, annualized kind of things that you're trying to deal with. Now, if you take a look at and break them down, this is how they look between 2021 and 2015. As you can see, motor insurance has pretty much been the number one. Obviously, because for you to have your car on the road, you must have insurance. So there is a compliance issue that drives motor insurance to be the number one issue as well. You can see 41% back in 2015, while we're seeing 39% in 2021. But as you can see, 35%. But fire insurance has actually started to pick up as well. From where it wasn't that important, it wasn't that popular. It's now become really, really popular. Obviously, more fires have been breaking out, and people are just more careful of the fact. And I keep telling people, if you own a house, you may want to be able to insure it, because just one spark in that house, poof, your balance sheet, your life savings, gone. Okay. And I want to talk about why, and I'm going to be talking about that in terms of what we're talking about, risk and probability and impact. So today I'm going to frame your mind as to why insurance is actually quite important. But if you look at even the life perspective, life insurance, well, group life or individual life insurance has been the main driver of life insurance altogether. 66% of the market is really general insurance, and only about 33% of premiums are property insurance. Are life insurance. But of this, you can see that more than 50% of it, as of 2015, was really life insurance and health. But if you can look now, we're looking at about 93% of the market is life and health. So you can see there's been an increase in health insurance uptake. And this is ex NEMA, but you can see there has been an increase in health insurance uptake across the country, especially because there's been a lot of aggressive selling amongst the insurance companies to get to as many companies as possible to say, look, if you don't want your employees constantly giving you issues about how sick they are, give them access to better healthcare. Okay, so it's actually quite important. And in fact, Vernon, it's actually a reason these days that some people even struggle to leave their jobs because they think about the health insurance they have access to. Some people have even struggled to take higher pay because of the access to health insurance. But this is where the insurance industry is sitting as a whole. I just wanted to chart it out to you. So Vernon, let me get your views as a general man out there. What is your take on insurance? And I'm talking about you from a personal perspective, maybe some of your personal experiences. Before we get into the depths of why we should do it, I'd love to hear your views on it.
Right. Thank you. So essentially, there is this funny narrative I've noticed with people when it comes to insurance in its general terms. Indemnification is awesome if you have something that is of value to you. You want to take every avenue possible. You want to have a look at it in every angle that it is secure. I think just yesterday I was having a conversation around the same, and that is adding value to property. And it all trickles back to the aspect of what you have valued the most. And people who actually have valued some certain things or valued properties of things of value, they want to keep it safe. In a very simple or very relatable example I would give is that of a father or a parent who is telling his child, do not drive the car because I know you do not know properly how to drive the car, and if you wreck the car it will be a cost. And sometimes these parents of ours, not everyone of course of them would actually be able to insure the car, so they know that they do not insure the car to a comprehensive level, where some of these even insurance companies will actually even give you another cause you're waiting for a car to be fixed maybe, or work out something for you as you actually find yourself in that regard. But something interesting I've actually come across is people have a very interesting narrative when it comes to security. Bruce Schneider actually is one of the interesting people actually has brought in a very interesting concept about security mirage, where you are people acting on intuition and people acting on models are built in a way that they are founded on rationality, and you do things because you are rationally looking at something, unlike where intuition is married with feelings or emotions, where you feel certain things are bound in a way based on your feelings. But if you rationalize and you think, for example, Mtwali, if you are driving, as much as of a good driver you want to become, or you tell us you are, another reckless driver will hit you. As much as you can try your defensive driving and whatnot, somebody's going to hit you at the end of the day. But how are you going to, ensure that? How are you going to, recover all of that cost and damage if you only, bought insurance for the other person? So as much as that can be, you can be as careful as you can be. You can always incur an electrical fault and then the whole building goes down in ashes. What happens to that? You can never be too sure. So if you say, well, I'm going to pray that my house doesn't go or, caught in fire. Good, that's some beautiful faith, and we pray it doesn't get caught in fire. But at the end of the day, if you rationally think about it, you can have an earthquake. What happens? You can have burglars breaking into your house. What do? So insurance, in as vulnerable and as and significant as it may seem, it is very cardinal that you have it. And it's funny and ironic that in other countries I've seen people insuring items as small as laptops, as small as phones. But in Zambia, if you ask somebody, you lost your phone, so do you have insurance on it? No, the first place they will go is the police, because they know they have no insurance, and the only way is either you retrieve it or you forget about it. But if you have it insured, if you're unable to track it, maybe even in good time, what happens? You have an insurance company is going to cover you for the item.
Oh.
Laptops, we don't value whatever we have and whatever we own as property at the end of the day. So insurance should not be taken in a way that I mean, of course I understand, when you talk about security, there's got to be some sense of economic incentive that has to be in exchange of value for a particular security. A song sung by Kings Malembe Malembe, he was talking about, well, I have locked my doors, I have a security guard outside, we have dogs, maybe just for security purposes, but still someone will still die. Why is that? The devil actually will still penetrate the walls and be able to enter and kill you, according to the song. But ultimately, if I do not pray to God to protect me, I don't need a dog outside. I don't need to put as many security measures and whatnot. If only God protects me, his protection is able to save me from any physical, any kind of harm, or any kind of danger at the end of the day. So that is another perspective of security. So you want to contextualize it in a way that of course you need protection from God. Absolutely, pray, people. Okay, but also be rational as you're going about. This is property, this is physical material. It can crumble down at a particular point, due to whatever circumstances. It can go down in flames. What happens to that? So I feel insurance, as much as it may not seem as necessary to a lot of people, because you never find yourself in that kind of a situation. Well, it is mandatory for those, of course, who have vehicles to insure their cars. That's for a particular reason. And it is also something that you should look at if you have property. I was at a particular institution at I think about 2 years back, and I was working with this institution, and they had discontinued their subscription with an insurance company after one manager actually, took over. And at the time this is very true, by the way. So the building went up in flames, and what happens, people were like, okay, at least we've been able to salvage whatever we could from whatever was burnt. But moving forward, we know the insurance company, of course, is going to come around. Guess what? Looking at the documentations, it actually had been about 2 years or so since the discontinuity of the subscription of insurance. And what happens? The unprecedented events happen, people. You will never think about it. You will try to be as careful as you can be, but things just by eventuate and they happen. So you want to ensure that you're covered. It may not feel or seem necessary at the time, but when that event hits, when it happens, you will thank God you actually have insurance. But anyway, those are just my thoughts about it. And I think moving forward, I'm learning to appreciate insurance, and also praying and believing in God that He can protect us in our lives at the end of the day.
So whenever we, and good morning to everybody who's joined us. Good morning, Mr. Sona, and good morning, Gift. Let me. I'm going to take a different stab at insurance today, because today I'm not going to talk mainly about the insurance types. I'm going to talk generally about why we insure, and I'm going to talk about the risk and consequence paradigm, so that we can get people's minds thinking correctly. Because usually there's this resistance to insurance, because I'm putting, as Chris Rock said, they shouldn't call it insurance. They should call it in case something happens. Because I'm putting money away in case. We don't get car insurance because we're hoping to have a car accident. We know that the event can actually be catastrophic to us. Okay, so you have to think about it that way. So people, this is why I said the cost of owning something. This is why you have to be careful about the things that you own and the things you engage in, because every single thing now has insurance attached to it. So you have to remember there's always insurance now you have to have. So if you own furniture, you have to be able to insure it against fire, theft, all sorts of things. So the 3 R's of responsible ownership are risk, repair, and replacement. So if you want to own something, you have to ask yourself the question: can you manage the risk costs? Can you manage the repair costs? And can you replace it when it's finally finished its lifetime? If you cannot answer yes to these 3 things, walk away from that item. It's not yours. Want what you want, but buy what you can afford. Remember what we've always said, Vernon. We said people tend to look at the cost of acquiring something, but they don't look at the cost of having an ongoing relationship with something. The house I have, and most people think, I often get this, there's often a huge debate, Vernon, that breaks out, where people will say, it's just, we want to own homes because it's rent-free living. It's rent-free living because you're not paying home insurance. Because if your house goes up in flames, poof, There's all your savings gone. Okay, and people don't seem to think about that. A lot of people are walking around with homes they own with zero insurance on them, zero insurance on them. And then what ends up happening is when something happens to that house, or if something happens, and we pray it doesn't, but if something happens to that house, you know what ends up happening? They lose a lot. Okay, so I think people need to try and make sure that they start to understand that insurance is the cost of owning something. You have to insure it. We get a comment here from Michael Monzo who said, "I'm sure people think of insurance, but when one looks at how much it would take, when someone looks at how much would be a take home to meet this and that, priorities come in milli-mil, and on top of things, eventually the postponed insurance. Otherwise, insurance is vital." And that's the thing, Michael. If you can't afford to insure something, don't own it. That's what I keep saying. I'm not saying you should be choosing between insurance and milli-mil. I'm saying if that is your choice, perhaps you can't afford that thing. You can afford to get it, yes, but you can't afford to keep it. That's where the problem is. People, there's a difference between acquiring something and keeping something. And a lot of people, in fact, let me be honest with you. I remember this statement actually being said by a lady who said, "Guys do a lot when it's time to get the lady, but once they marry her, yeah, they slack." And this is what people do when it comes to keeping things even in their homes. They pay a lot for that TV, but when it comes to insuring it, repairing it, keeping it, they let that thing deteriorate. They pay a lot to get a car, but when it comes to keeping that car, it deteriorates. Have you noticed that the relationships we have with things are worse than the acquisitions? That's where the problems are coming from. But I want to talk about insurance from a different perspective, because people tend to think of insurance as nonsensical. They'll say it's a scam, it's all that, but it hides this. So I'm going to take a different approach to it. Okay. And we're all adults here, so we're going to have an adult conversation. Right. So, Vernon, I take it you're above 21. So we're just going to have to make sure of that. Right. So in general, people, it is wise. It has been spoken to even at schools, even to everyone, to people, that when engaging in things like intercourse, one must use protection. Correct, Vernon? That is what we advise people to use. Utilize protection. Why, Vernon? Why do we utilize protection? What are the two main things that people that people utilize protection from? One is they utilize it for, obviously, from the transmission of STIs and probably STDs. And the main one, let me put that into our mind, is HIV. Okay, the biggest push that we've had for people to utilize protection has been the transmission of HIV, to slow down the transmission, and also pregnancy. That when you're trying to avoid unplanned pregnancy, because we're not going to lie to ourselves that people aren't doing things that they should or shouldn't be doing in the backgrounds. Let's be realistic and pragmatic, as we talked about earlier. But then let's be realistic and pragmatic here. So what is the percentage probability that a person can contract HIV on a single sexual encounter with another human being? Well, the probability, and I'm using some high level here, is that the prevalence of HIV in Zambia is about 12%. It ranges to about 30% with some age groups, but 12% in general at a national level. Okay, but we're gonna use 14% actually as the number here. 11% at national level, but we're gonna use 14% as the national level here. And they said the probability, according to a Stanford study, which looked at the probability of a successful transmission of HIV from one person to another through a single interaction, or a single act of intercourse, is 2%. Okay, it's actually less than 2% chance. So that means there's only a 0.22% chance, Vernon, that a person can contract HIV from a single encounter. That is what they do. Okay, then so we're looking at a 0.22% chance, and at the same time, we also have if we're looking at pregnancy, women in general, and this is just a bit of rudimentary math, people. 5 days a month, a woman is able to become pregnant, and only a 20% chance that on those 20% of days of the month that you can actually impregnate somebody, that sexual intercourse can result in pregnancy. There's only a 20% chance. So we're looking at a 20% of 20%. So once again, a 4% chance. Okay, so we're looking at about a 4% chance that a pregnancy can come about. So we're talking about using protection from things that are a 0.22% chance of happening and a 4% chance of happening. Why, Vernon? Because if these things happen, okay, if you are part of that 4%, these are life-altering situations. That's what it is, okay? These are life-altering. And the reason I use this example, because when you try and talk about car insurance, how it doesn't resonate with people. So when I ask people, why are you strapping up on something that's only a 0.2% and a 4% chance of occurring? Because these are life-altering outcomes if they happen. So you don't even want the slightest opportunity for this thing to occur, okay? You don't even want the slightest chance, even though they'll tell you that protection is only about 95% effective. But anyway, that's another conversation for another day. But that's the reality. So whenever you are doing that, gentlemen, you are, and I know that you all want to pretend for your churches and so forth, but we know you. Whenever you are doing all of that, gentlemen, you're strapping up, that is insurance. That is you doing risk management and insurance. Okay. So I want you to put that into your mind. That is a form of risk management. So now let's take this into the rest of your financial life, that same behavior. So I just wanted to tell you that you can't say, oh, this has a low chance of happening. When you are there and you're utilizing protection, you're dealing with things that have a low probability of happening, 4% and 0.22%, but you're still taking those precautions. Why? Well, most people take those precautions. But why? Because it's that important, because you know the impact of the outcome. So let's talk deeper, Vernon, today, because we're going to talk about risk and the probability of things occurring. So I just wanted to frame that in your mind, people. It's not going to be a conversation all the way like that. I was just giving you a basic thing to think about because it resonates with more of you. It resonates more than the stuff I'm going to talk about. And unfortunately, Vernon, we have to speak to the audience. We have to make sure they understand. So now let's get into the risk and probability conversation. Now, risk, by definition, is the chance or the occurrence of something harmful that is unexpected, occurring by incident or accident that might have financial loss implications, okay? Or it might even create a loss of a human being, right? So such incidents include the loss of one's life, the loss of one's ability, the loss of one's health, the loss of one's possessions, and the loss of one's assets. So whenever we're looking at anything where a loss has a tangible financial impact on a person, okay, or a situation, that is what we're looking at. We're deeming in this situation as an insurable risk. So let's give some examples of this in terms of what we're looking at as probabilities. These are crude mortality rates for Zambia. Okay, as you can see, Vernon, these are the rates of the probability that a person will pass away by age. Okay, so you can actually look at it very carefully. That's the probabilities that you'll actually pass away by age. And if you look at it very carefully during these years, so let's take a stab at a man at the age of 25 to 29, there's a 0.5% chance you will pass away that year. So 1 in 2,000 chance. So if there's 2,000 of you, one of you will just die that year, whatever the issues are. Women at 0.3. And as you can see, the older we get, women have lower rates of mortality. Men have higher rates of mortality because, guys, we like playing around. Now, if we're looking at between the age of 24 to 49, there's a 4% chance, Vernon, you will not make it. A person will not make it to the end of 49. And there's a 3.2% chance a woman will not make it to the end of 49. So you can see this is how it looks like. So this is, now, why have I picked 25 to 49? Well, Vernon, those are the times where you're working. Those are the times where you own stuff. Those are the times where you're looking after people. You're most likely a parent. You're most likely a spouse during these ages. So there's somebody out there who's depending on your income. So if anything happens to you, that person now is in trouble. Now, we're not even talking about disability. We're not talking about any other things. We're just even talking about this right now, the fact of passing away. Okay. So there is a 5% chance you will not be here to see the end of 49, and your kids will not have a parent who can earn for them. Your kids, your spouse will now be hamstrung and be having half the income if you weren't the outright breadwinner. So you see the issues that are now starting to come about here when we're working these numbers out. Now, if we're looking at even cars, Vernon, every year there's a 4.55% chance in Zambia that the probability of a car will be involved in a traffic accident in a calendar year. Over a 5 to 7 year span, that means there's a 25 to 36% chance that your car is likely to face at least one road traffic accident. You own a car for about 5 to 7 years. So in that lifespan where you're going to own that car, you are probably going to, there's a 25 to 36% chance you are going to be engaged in one road traffic accident. Okay, so you already know that this is a catastrophic event. So I'm talking about catastrophic events, even though they've got low probabilities, you don't want to take chances. Now, hazardous event in this definition basically is the risk that is stated above. Now we're looking at the potential actual impact. So whenever we're looking at your risk exposure, Vernon, your current risk exposure is always going to be the probability something can happen, the car accident, multiplied by the actual financial loss. So let's say the value of, let's say we're saying that a car accident is 4%, 4.5% of occurring. And let's assume the replacement value of your car. If you lose your car, you have to get a new car. It's 50,000 kwacha. Okay, so if you multiply the two things together, then what you end up getting is about 250 kwacha. That's how much risk you are exposed to in financial terms. So have you covered yourself? In other words, that's the risk you're carrying. So whenever you're looking at premiums, you measure it against this risk exposure. That's what you're looking at. Whenever you're looking at the premiums you should be paying, you measure it against the risk exposure. What's the probability something can happen multiplied by the cost that if it does happen, and that is the risk, and then you're measuring it. So if your premium is higher than that, then you've got expensive premiums. If your premium is lower than that, then you've got a cheap and good affordable premium. But you also want to make sure you're dealing with the reliability of that insurance company to pay the insurance out when that is, or if that situation arises. Okay. So I want you to just frame this in your mind. So I gave you the example earlier, Vernon, of why people use protection, but let's now look at it even from cars here. So there's two things you have to look at. Now I know we're back to math class here, people, but this is just a way of understanding it to try and help you here. But if you look on the X and the Y axis, or let me say the vertical, the one going upwards and the one going across. The one going upwards is the probability of an event materializing. So what is the percentage chance? What percentage probability can something happen? Versus the potential impact if it does happen. Okay? So how much kwacha, what is the kwacha value of this thing happening? So if you look, there are 4 quadrants here. There's what we call high risk, low impact. So yes, it can happen, but it's not going to impact me too badly. We look at low risk, low impact. Yeah, even if it does happen, it happens a lot, but it's not something that's going to hurt me much. You know, it's part of things. Then there's high risk, high impact. This is highly likely to happen, and if it does, it will destroy me. Okay, and then there's low risk, there's low risk but high impact. Now it's unlikely to happen, but if it does, this is serious. Like my whole life will change, and that's what I talked about using that example. And this kind of puts you into the mind of what to insure. Okay, so when you're looking at this, let me give you this is a basic framework that says a risk that is high but low impact. Let's say you're driving fast. Okay, now if you're driving fast, especially on Kafua Road, you are highly likely to get caught. You are highly likely to get caught. Okay, you're highly likely to get caught speeding, right? But if you do, the fine is what? If you're driving a car, people, I'm sure you can pay the fine. Okay, so the fine is about 500 or so, and the fine can be 1,000. But I'm just saying that you'll pay the fine. You can afford the fine; it won't destroy you. You just may not have the cash at that moment, but somewhere along the time, you will have money to pay the fine. Okay, so it's what we call a high risk, low impact. If you're speeding, highly likely you get caught, but at the same time, you can manage the fine. Having a flat tire or an easy to fix problem of your car, you accept it. So what you want to do with speeding is you want to reduce your probability of being caught. So people practice tactical speeding where they speed in areas where they know, or they just don't speed. They try and stay within the speed limit to reduce the probability. So they know that the impact can't be reduced any further. So they reduce the probability of being caught speeding by not speeding. Okay, that's what they do. They just obey the speed limits. Okay, that's one of the things that they try to do. So the other part that we start to look at, Vernon, is also risk and impact. So if there's low risk, low impact, you accept it. It's the cost of doing things. So remember, I said the cost, the 3 R's of responsible ownership are repair, replacement, and maintenance. Well, if you can repair something, it's usually a low cost. If you're looking at repairing the charging port on your phone, that's a low cost issue, and it doesn't happen much. Let's say the charging port on your phone breaks down. It doesn't cost that much to fix. You may not have the cash at that moment, but in terms of the amount it costs, it doesn't cost as much. You can get that thing fixed pretty quickly, and then you can move on with life. So you accept it as the cost of owning a phone. That's one of the things you do. You just accept it as the cost of owning a phone. Then when you're looking at high risk, high impact, these are things you should avoid. I've given the example. So these are risks that should not be taken at all. You should not even analyze potential gain. Just walk away. Okay. For example, drag racing while drunk in daylight. You can get arrested. You can die. You can kill. It's just too much. You shouldn't even do it. Okay. You shouldn't even do it at all. And then the fourth quadrant there, so that's an avoiding risk. So you avoid such behavior. Okay. And then the final one is what we call low risk. In other words, the probability of it occurring, like a car accident, is only a 4% probability of occurring. But if it happens, it has catastrophic impact. You lose a whole vehicle. A house fire is less than a 1% chance of occurring. But if it does happen, it's a catastrophic thing. If a flood is a once in a lifetime situation. If a flood comes, but let's be honest, Vernon, a flood almost took out houses in Eastern Province. You see, but that's a once in a lifetime situation. So you got to recognize that these may be once, but if they materialize, they are shocking. So what you do is you share the risk with another party who is willing. So you think about a car accident. So I've given you 4 situations here. The flat tire on a car, you can accept that. That's a cost of driving a car. You can't really insure against it. Speeding, you try and reduce your chances of being caught speeding or not having fitness and that by just adhering to the law. Drag racing, you just don't do it. Listen to people. You just don't do it because there's just too much danger and it's likely going to happen. And then the low risk outcome is a car accident. It's a 4% chance of happening. It's a 1 in 20 chance that your car will be involved in an accident that year, but if it does happen, it can wreck you. So we're looking at the fourth quadrant. So ask yourself, whenever you're looking at things that can materialize in your life, risks that you're facing, look at them from that perspective. Acceptable risks are things like repair and replacement. Those are acceptable risks. Okay. We reduce the risk. We reduce the risk of having to replace a car at the end of its life by putting away a sinking fund for the next car. That's a reduction method. Okay, we reduce getting caught in violations by not by putting aside by obeying the law. We don't engage in dangerous activities with vehicles. So this is just a way to kind of think about it, Vernon, to put it in your mind. By the way, this is also the same to do with going into business, Vernon. One of the things that are told to many entrepreneurs is, how okay are you with this business drowning, like with this business going down? When you look at the worst case scenario, are you okay? And and I want to put it to you this way: if the business has a high risk of failing, and it will, in the horizontal line, the way it says potential value of loss materializing, I want you to also think about emotional loss. Okay, if just for a business, by the way, I want you to think about emotional loss. Even with people, by the way, with life insurance, funeral insurance, those things, I also want you to think about emotional loss because that really affects you. So if there's a huge emotional loss, Vernon, that you will take, you'll go into depression. It may drive you into a different state of sanity if your business falls apart and there's a high risk it will fail. Perhaps don't do it. Okay? Perhaps don't do it. But if you look at the failure of the business and say, I'm okay with this, I can manage this, then it's an acceptable risk to you. Okay, now you just want to maybe reduce the probability of it failing. Now, if the business has a low probability of failing and it has a low impact if it fails, say you start small, but it has a low probability of failing, you're like, I can accept the loss as a cost of doing business. But if the business has a low risk of failing, in other words, you've possibly de-risked the business, but if it does fail, it has a huge financial and emotional impact on you, you share the risk by bringing on an investor. by insuring against those things. So that's when you can bring on an investor, when you have reduced the risk of failure down to a negligible number, but you just don't want that risk to materialize. So you bring in investors when you have reduced it. And investors are also comfortable investing when they can see you have de-risked the business. Do you see now why this is important for you to even look at this framework in general? Even going into joint ventures, you do that. So quickly, Vernon, as I said, transferable risks. You want to just focus on transferring the risks, and that is where we insure. And as I said, your premiums that you pay, the cost that you pay for that insurance to an insurance company should always be measured against the probability something can happen versus the financial cost. If it does times the financial cost, that's your risk exposure, and then you measure that. So you just want to make sure the premium is always less than the risk exposure. You've got yourself a good deal. So we're always looking at things like loss of life and the potential impact on surviving loved ones, potential loss of critical property that I own, or potential loss of a future ability to reach a future goal. So like, let's say you're saving for your child's education. That's something you want to try and keep into your mind. So how much insurance should you get? This is a number we're going to cover very carefully. People take a look at this. The potential value of loss materializing minus the current assets you have that can cover it, because you also have financial assets that can be liquidated to cover this risk, by the way. So if you've got capital, you may not need that much of a life insurance policy. If you've got bonds, if you've got benefits, if you've got all those things, you may not need much of a life insurance policy anyway. In general, you may not need these other things altogether. But just quickly, Vernon, I wanted to just give some final thoughts. I know that we've run into some time here, but I wanted to give some final thoughts because we usually get the Christian answer, as you said. We can pray these things away. No, Jesus is my insurance. Well, Jesus said, in this world, you will have trouble. Okay? So the same Jesus, by the way, has told you, who told you that nothing wrong is going to happen to you in this world? John 16:33, in this world, you will have trouble. So if you think there's no risk, you have gamed yourself. He just says, take heart that I have overcome the world. Your pain will not result in suffering, but don't lie to yourself that there are no things you need to insure against. There are a lot of things. And Jesus has told you up front here, you will face trouble. King Solomon says, send your grain across the sea in time, profits will flow back. But divide your investments among many places, for you don't know what risks may lie ahead. Okay, this was meant to be the wisest man in the Bible, who's basically telling people risk is part of life. These things happen. You will fall sick. You will have trouble. You will have issues. Robert Kiyosaki finally says, to be a successful business owner and investor, you need to be emotionally neutral to winning and losing. Winning and losing are part of the game. So that's partly what I want to explain to people. If anything you want to take, please break down the probability for in terms of break down your probability of something going wrong. One point here, I think that has been asked by one person, Suzy, is saying, "Good morning, Munyumba. Is a law that prohibits in-house insurance? Is a law that prohibits in-house insurance? For instance, you sell a product, but within your organization, part of the profit is sent to an insurance account. And should this happen, I'm supposed to pay insurance tax on that initiative." You're gonna have to be a little bit specific. Suzy, inbox me, and then we can try and figure out what you're going through in that situation, because I'll need a bit more detail. But however, Vernon, that's the breakdown. Insurance is just about protecting yourself, for lack of a better word. Insurance is just a form of protection against risk. That's it.
Alrighty, you have a good day.